Equities have sold off, bonds have rallied hard, yields have dropped a lot. Of those two asset classes, which one do you think's too far extended? Which one would you be leaning the other way?
Well, I think the bond yield is getting pretty close to a bottom here. If you look at the peak yield curve spread, so I'm looking ahead already beyond the disinversion that we've just seen to how much of an ascent are we going to get in this yield curve. It could be at least 100 to 150 basis points. And so the bond market's discounting lots of rate cuts, and I think that reflects a misleading view that the economy is not resilient after all, and that we're finally going to have a recession, and that's just not my opinion. It looks to me as though the economy is going to be particularly strong this month when we look at August data for personal income and personal consumption. That looks like it's going to be a very strong number, as does industrial production, which we're likely to see some offset to the auto drop that we saw in July. The auto production dropped significantly in July, which probably just was a seasonal aberration. So you put it all together, and I think we're going to get some pretty good economic indicators here. I think the stock market has had another carry trade hissy fit, as we saw in early August. And that's because the Bank of Japan has announced that they are still on course to raise interest rates. And so the weak employment numbers, perversely, you would think that the weak employment numbers would make the stock market go up. Why? Because the Fed's going to do 50 instead of 25. And that kind of thought really unwound the carry trade once again. And I think that's why the stock market was so weak last week.
And let's pick up on that point. There's a lot to unpack there with the yen carry trade. Mike Wilson over at Morgan Stanley talking about how there's still a lot more to go in terms of that trade unwinding. Do you agree?
Well, I think that view is too pessimistic. I think the carry traders got the message in August, got it again on Friday. I think a lot of it has, in fact, been unwound. But I do agree that if the Fed goes for 50 at September 18th, there'll be more carry trade to unwind. So you would think with a bigger than expected drop, or instead of 25, 50, I guess 50 is increasingly expected. Well, if that were to happen, I think you'd get probably another round of carry trade in a difficult market, but I think they're going to go for 25.
Well, hold on a second. This is actually fascinating, especially because you were talking just a couple months ago about how if the Fed were to cut rates, that would turbocharge equity markets to an unhealthy degree and could create another bubble. And yet, from the technical setup right now, actually, an outsized rate cut by the Federal Reserve would actually depress stock valuations. So can you pair these two ideas?
Oh, yeah. Time is money. What's changed what's changed my view is I didn't see the carry trade unwind coming. However, if you look at a chart of the Nasdaq versus the yen, it's pretty clear that there's been a very strong inverse relationship. A strong yen caused by this differential in monetary policies is bad for the Nasdaq because it unwinds the carry trade. So that's what's really changed in my thinking. But the carry trade will unwind, and we're going to be left with somewhat lower interest rates, and that could very well lead to a very strong year-end rally. So I think lower interest rates are still bullish for the stock market, and could very well give us something that, believe it or not, looks like a melt-up by year-end.